Inventories. In this reading, we will talk about the cost of inventories, inventory valuation methods, measurement of inventory value, presentation and disclosure, and finally, evaluation of inventory management. As we have discussed before, inventory is shown as a current asset on the balance sheet. For manufacturing and merchandising companies, revenue and profit is generated through the sale of inventory, and for many companies, inventory represents a significant asset. With regards to inventory accounting, there are a few important differences between IFRS and US GAAP, and those differences will be highlighted in this reading. Cost of inventories. Capitalizing inventory-related costs defers their recognition as an expense. We have talked about this in earlier readings, but I will explain again what we mean by this because the concept is extremely important. Let's say that a company either builds or purchases inventory in period 1, and then this material is sold in period 2. Given that the inventory is sold in period 2, it makes sense for the expense to also be recognized in period 2. So if the money is spent on inventory in period 1, how do we make sure that the expense is shown in period 2? The way we do that is by creating an asset called inventory. This is called capitalizing inventory cost. So if you spent $10 on creating a piece of inventory, then in period 1, we create an asset called inventory worth 10. And then when this particular asset is sold in period 2, that is where we remove the $10 from the balance sheet and show it as a $10 expense on the income statement. That expense is called the cost of goods sold or cost of sales. In this particular section, we will get one level deeper and ask the question, which costs are capitalized and which costs are expensed? And the answer is given right here. When you create inventory or purchase inventory, the following costs are capitalized. And again, capitalized means that we create an asset on the balance sheet. The cost of purchases, so if you are purchasing raw material, the cost of raw material needs to be capitalized. So if raw material for a given item is worth $3, that is capitalized. The cost of conversion, so converting the raw material into the finished product, let's say that cost is $4, that also needs to be capitalized. The cost of conversion can have several components. For example, direct labor, which is the labor that is directly involved in converting the raw material into the finished good. You might have direct overhead, so factory-related expenses that can be directly connected to the inventory, and then material, which we have already talked about in terms of raw material. The cost necessary to bring inventory to its present location and condition. So if you are creating inventory and then you need to put that inventory in a particular showroom, which is the location from where you make your sales, the cost of taking the inventory to the showroom is also capitalized. However, any cost associated with shipping from the showroom to your customer is not capitalized. In terms of transportation cost, the cost of transporting raw material is also capitalized. Period costs are expensed in the period where they are incurred. If while creating inventory there is some abnormal wastage of materials, then the associated raw material cost, labor, overhead is all expensed. The larger thought behind this is as follows. The definition of an asset is something that will give you a future benefit. If you are creating tables or chairs and because of some defect you have to scrap 100 tables, then all the cost associated with those wasted tables has to be expensed because there is not going to be any future benefit of those tables. Storage costs need to be expensed, and the logic is fairly straightforward. If you started capitalizing storage costs, then that would mean the value of the inventory would keep going up the longer you store inventory. So again, storage costs are expensed. Any administrative overheads are expensed, and selling costs are expensed. As discussed earlier, selling costs might include the cost of transporting goods to your customer. Let's consider a simple example. This company manufactures high-end tractors. The inventory-related costs are shown below: raw material, direct labor, etc. What value of inventory is recorded? Essentially, this question is asking which of these costs need to be capitalized. And obviously, what is not capitalized will be expensed. Raw material is directly tied to the product, so this needs to be capitalized. Direct labor 40,000, this is capitalized. Abnormal wastage, let's say that one or two of your tractors are defective and need to be scrapped, so that cost is expensed. We are assuming here that this abnormal wastage cost is not already covered over here. Transportation of raw materials, this is capitalized, and storage of finished product, this is also expensed. So our value that is recorded is going to be 56 plus 40 plus 10, which is 106,000. Coming now to inventory valuation methods. Here are the different methods we'll talk about: specific identification, FIFO, weighted average cost, last in, first out. Before getting into the details, I will quickly set the context. Say you are a trading company, you buy your goods, you store them, and then you sell. Let's say that when you buy, the buying price is not always the same. You buy an initial batch where each item is worth $1, and then maybe you buy a second batch where the cost of each item is 1.5. Now, if you sell two items, the question is, what cost should you use for each item being sold? The different possibilities include using the last price or the most recent price, or you could use an older price, or you could use an average price. Now, the decision that we make depends on which valuation method is being used. Let's start with the method called specific identification. This method is used for inventory items that are unique in nature and not ordinarily interchangeable. This method allows for cost of sales and ending inventory to reflect actual costs incurred. So if you sell jewelry, then obviously you would keep track of every item in your inventory individually. So this particular ring will have a particular cost. You will have this ring tagged with a particular ID, and then when this particular ring is sold, the cost would be the cost of this particular ring. So this method is specific identification, and as you can see, this method would apply where the cost of inventory is high and also where the items are not ordinarily interchangeable. Another inventory valuation method is first in, first out, or FIFO for short. This assumes that the oldest goods purchased or manufactured are sold first, and the newest goods purchased or manufactured remain in inventory. Let's understand this through a simple example. In period 1, you buy two pencils for $1 each, and then you buy another two for $2 each. So initially your inventory looks like this: 4 pencils, you bought 2 of them for $1 each, and then you bought another 2 for $2 each. Before you start selling, this is your inventory. You then sell 2 pencils in period 1. Under the first in, first out approach, you will sell the 2 pencils that you bought first for $1. Now, with this method, what is the cost of goods sold for period 1? Let's say that those 2 pencils which you purchased for $1 each were sold in period 1. Notice the cost of goods sold is going to be $2. Why? Because each of those items was for $1. And then the inventory at the end of period 1 would be your 2 pencils, which are each worth $2. So your inventory at the end of period 1 is $4. Notice that with first in, first out, these 2 items were sold first. These are the items that you bought first, and you are left with the 2 items that are $2 each. Then in period 2, you sell these 2. So the COGS is 2 times 2, which is 4, and the inventory at the end of period 2 is 0. A very basic point over here, while it seems like we are selling the particular item that we bought for $1 and the particular item that we bought for $2, but in reality we are not exactly tagging each item and selling the item that we bought first. This is simply a method of allocating the cost. So when you have 4 pencils, they are sitting in inventory, they are all the same. It's only in your costing system that you keep track of the fact that the first 2 items that are being sold are the items that have a cost of $1, and the second 2 items have a cost of $2. Last in, first out, this method assumes that the newest goods purchased are sold first and the oldest goods purchased or manufactured, including beginning inventory, remain in ending inventory. This method is allowed under US GAAP. It is not allowed under IFRS. Continuing with the same example, in period 1 you buy 2 pencils for $1 each, and then again 2 pencils for $2 each. So this is your inventory at the start. Now in period 1 you sell 2 pencils. The question is, what is the cost associated with the 2 pencils that you sell in period 1? With last in, first out, or LIFO, these are the 2 items that are sold first. So the COGS now for period 1 is going to be 4. Ending inventory consists of the items that you purchased for $1. So the ending inventory is 2. In period 2, you sell these 2 items. So the COGS is $2 and the inventory at the end of period 2 is 0. Weighted average cost. This method assigns the average cost of goods available for sale during the accounting period to the units that are sold as well as to the units in ending inventory. The simple formula that you can try to remember is as follows. Weighted average cost is total cost of units available for sale divided by the total units available for sale. If we consider the same example and calculate the period 1 COGS. Now notice, before you come to period 1 COGS, you have to come up with weighted average cost. This is the total cost of units available for sale. Remember, you bought goods for $1, $1, $2, $2. So the total cost was 6 divided by the units available for sale, which was 4. So your weighted average cost is 1.5 per unit. In period 1, you sold 2 items, so the COGS is 3. Inventory is 2 at the end of period 1, so again the ending inventory is 3. Period 2 COGS is also 3, and inventory at the end of period 2 is 0. This table summarizes what we have been talking about and adds a gross profit element. Assume that each item was sold for $5. As we've already discussed, with FIFO, the COGS is 2, and then in period 1, if you sell every item for $5, that means your sales were 10 and the gross profit would be 8. What you can do is pause the video over here and just make sure that you understand all these numbers. These numbers are essentially based on what we have just discussed. And then do example 2 in the curriculum. It's a slightly long example, but really illustrates the points that we are talking about here very well. Try to solve this problem now and pause the video, come up with your answer before you look at the solution. Here is what you should come up with. The ending inventory should be 125, that's the number of units, times 325, which was your price at which you bought the second batch. What I want you to do now is also compute the ending inventory, cost of goods sold, and gross profit using all the methods, FIFO, LIFO, and weighted average cost, and post your answer on our group, which is given right here. You have been asked to join this group. I think it is useful if you post your answers and then also compare with what your colleagues are doing. Periodic versus perpetual inventory systems. In a periodic system, a company determines the quantity of inventory on hand periodically, and hence it is necessary to maintain a purchases account. With a periodic system, the ending inventory is determined through a physical count. So if this is period 1, this is period 2, then typically there is a physical count at the end of every period, and that determines the inventory balance on those dates. Again, those dates tend to be beginning of period or end of period dates. During a given period, a purchases account is maintained which tracks how much is being purchased, and then the cost of goods sold for a given period would be equal to the beginning inventory. So let's say beginning inventory is 10, and then purchases during a period, let's say 50. Ending inventory, let's say, is 20. Then your cost of goods sold is going to be beginning inventory 10 plus 50, which is 60, minus 20, which is 40. So notice that you compute COGS using the inventory values as well as the purchases over the period. With a perpetual system, changes in inventory and COGS are continuously updated, and that is the critical difference between a perpetual system and a periodic system. Typically, companies that use computer systems such as SAP would have a perpetual system. Connecting periodic and perpetual systems with what we have discussed earlier. If a company uses specific identification or FIFO, then periodic and perpetual systems give the same values for COGS and ending inventory. On the other hand, if a company uses LIFO or weighted average cost, then the choice of system, i.e. periodic or perpetual, might impact values for COGS and ending inventory. From an exam perspective, simply knowing what you see over here should generally be enough. But if you really want to understand this material very well, then I would encourage you to do example 3 in the curriculum. This example builds on the earlier example in the curriculum and focuses on the difference between a periodic system and a perpetual system. This slide is extremely important from an exam perspective, and it deals with the comparison of inventory valuation methods. Very often on the exam, there might be a question that talks about two companies, A and B, where these two companies are very similar. One uses LIFO, so this might be a US based company, and company B uses FIFO. And you need to recognize that simply because these companies use different inventory valuation methods, they are going to have different numbers reported on the balance sheet and income statement. In an environment where we have rising prices and stable inventory. The COGS is going to be higher with the LIFO firm. You have seen this in our earlier examples, but I'll tell you a quick way of remembering this. Just look at rising prices, stable inventory, and connect with the example that we talked about. Put in 1122. This represents what you paid for your inventory. With last in, first out, essentially what you are doing is selling the items that you bought last. If you sell these two, that means the COGS is going to be high, and obviously then FIFO is going to be low. These top three items are from the income statement. If COGS is high, that means that your expenses are high, which means that your profit before tax is low, and hence taxes will be low. Similarly, your earnings before tax and earnings after tax are going to be low because the cost is high. For FIFO, you are always going to have the opposite of LIFO. Inventory balance with LIFO is going to be low because remember, you are selling the 2 and you are left with 1, which gives you a lower inventory balance. Current asset minus current liability, this is your working capital. This is going to be low under LIFO because current liabilities are not impacted by the method that you use. Current assets are. If current assets are lower, that means working capital would be lower. And note that this then would impact your ratios like the current ratio. This is extremely important. The cash flow after tax will be higher with LIFO. The reason is that tax, which is actual cash flow, is lower with LIFO. Since the tax is lower, therefore the cash flow is higher. US GAAP companies which have a choice between LIFO and FIFO will invariably choose LIFO because with LIFO they pay lower taxes and hence have higher cash flow. As a general point, the numbers for weighted average cost will be between LIFO and FIFO. So if you get a question on the exam comparing LIFO with weighted average cost, what you can simply do is think of this table and just remember the fact that LIFO is going to have a COGS that's higher than weighted average cost, taxes that are lower, and so on. Again, that would be in an environment with rising prices and stable inventory. On this slide, I want to make another important remark. Using LIFO gives us a better income statement, and using FIFO gives us a better balance sheet. Now let's make sure we understand this term better. Better in this context means income statement that reflects the current economic reality. When we use LIFO, we are saying that cost of goods sold is based on last in, first out. So the cost shown on your income statement is based on the current prices of 2 and 2. Clearly, that is more accurate than showing a cost on the income statement based on 1 and 1. On the other hand, FIFO is better for the balance sheet. Why? Because with FIFO, we are saying first in, first out. So these two items are shown on the income statement, which compromises the quality of the income statement, because on the income statement we are now showing a cost that is lower than the current value of inventory. But on the balance sheet we are showing 2 and 2, which reflects the current value of inventory. So again, better means which method is better reflecting the current economic reality. What you need to do now is fill out this table for falling prices and stable inventory. Pause the video before you see the answer. Here is what you should come up with, and the shortcut method again is as follows. Falling prices and stable inventory. So quickly put in the 2211. This means that you initially buy your inventory for $2, then for $1. With last in, first out, you are selling the $1 inventory first. which means that your COGS is going to be low. If COGS is low, that means expense is low, profit is high, therefore taxes are high, earnings before taxes and after taxes high. The inventory balance, we are left with these items. So inventory balance is high, working capital is high, and cash flow is low. Coming now to the measurement of inventory value. We will first talk about IFRS and then about US GAAP. To understand this concept, we will go through a simple example. You purchase inventory and initially the cost is 10, which is what you capitalize. But then the net realizable value is lower than 10. So for some reason, the value of that inventory comes down and the NRV comes down to $8. Net realizable value is the estimated selling price less selling cost. So your inventory, let's say you think you can sell it for $8.50 and the cost to sell is 50 cents, which means the NRV is 8. If NRV is less than the balance sheet cost, which is the case over here, the inventory is written down to NRV and the loss is recognized in the income statement. Typically, this loss or expense is shown as part of cost of sales. The treatment on the balance sheet then is to take the $10 inventory and write it down to 8. This is the balance sheet. That loss of 2 then is shown on the income statement as a expense. If there is a subsequent recovery in value, let's say that the NRV now goes back up to 11, the inventory can be written up and a gain is recorded in the income statement, but the amount of any such gain is limited to the amount previously recorded as a loss. What this means is that from 8 we can only come back up to 10. That is the gain that we can show. So on the income statement we show a reversal and recognize 2 as a gain. We cannot do more than that. So the cap essentially is the original amount that we had on the balance sheet. Commodities and agricultural goods prices can be reported above the historical cost. This is because with commodities and agricultural goods, we have ready markets with clearly known prices. These goods are considered extremely liquid, so the price on the balance sheet is essentially shown at fair value. These are items which we mark to market, a concept that we have discussed before. In this particular case, we are not limited by the cap of $10. Let's do a simple example. In 2010, the inventory balance is 52. So this is 2010. Initially, the inventory balance is 52, but NRV is 49. What do we then do according to IFRS? We then on the balance sheet have to write down the inventory to 49, and on the income statement we show a expense of 3. The current replacement cost is 47. This term is going to be used when we talk about US GAAP. The next statement also is relevant for US GAAP that we will talk about on the next slide. In 2011, the NRV was 5 greater than the carrying amount. So our carrying amount is 49, but we are told that NRV, the net realizable value, is 5 greater. So NRV is now 54. Show the inventory values in 2010 and 2011. We've already shown the inventory value in 2010. In 2011, what can we do? We can write the inventory back up to 52 and that's it. That represents the cap. On the income statement, we will show a reversal of this expense of 3, and the point is that we cannot write all the way up to 54. according to IFRS, we have a cap of 52, which was our original historical cost. Now we will talk about measurement of inventory value using US GAAP. Here the principle is that we use lower of cost or market. Note that with US GAAP the term used is market and not NRV. NRV is going to be discussed later, but the initial comparison is between the cost price in our original example, that was 10, versus market price. Market price is the price at which you can purchase the good from the market or purchase the inventory from the market. And just to draw the distinction between this concept of market and NRV, NRV takes a selling perspective where you say, if I sell the inventory, what can I sell it for less selling cost? Whereas market price takes a buy perspective. Often these two would be very similar. In any case, let's say that the market price is 7. According to US GAAP, what we then do, simplistically at least, is write down from 10 to 7. US GAAP then goes and provides a further clarification. So we have written down our inventory to 7, but then we need to check whether this 7 is in a certain range. This 7 has to be within a range where the upper limit is the NRV and the lower limit is a NRV less a normal profit margin. Let's say that the NRV is 8, the net realizable value is 8, and the normal profit margin for this sort of inventory is $2. So 8 minus the normal profit margin of 2 is 6. What that means is the market price is indeed falling within the appropriate range, so we can show our inventory at 7. If the market price had been 8.5 and NRV is 8, then we would have to show the inventory at 8. We cannot then show it at 8.5. On the other hand, if the market price is 5, then we need to show the inventory at 6, not 5, because 6 represents the lower limit. Another important point related to US GAAP is that we are not allowed to write up at all. In other words, if there is a recovery, then there is absolutely no write-up. So once we've written down to 7, after that, if the market price goes up to 8, we have to stay at 7. I would suggest that you do example 4 in the curriculum that covers the concepts that we have talked about. This is the same example that we saw earlier, but now we need to solve this according to US GAAP. So in 2010, we initially had our item or our inventory for 52, NRV is 49, and current replacement cost is 47. Replacement cost and market price or market value are used interchangeably. According to US GAAP, we need to write down to the market value. So we write down to 47. This figure exceeds the net realizable value less a normal profit margin. Now remember, I told you that this number that we write down to, the market value, has to fall within a certain range. That range is NRV and NRV less a profit margin. We already know that NRV is 49. So 47 is below 49, which is good. And we are told that 47 exceeds NRV minus a certain profit margin. So essentially the point of this statement is to confirm that 47 is in the appropriate range. Hence our inventory can now be shown on the balance sheet at 47. In 2011, the NRV was 5 greater than the carrying amount. So initially carrying amount is 47. The NRV is now 5 greater. So NRV is equal to 52. What do we do? If you remember from the last slide, with US GAAP, we cannot write up. So once the item is at 47, it has to stay at 47. It cannot be written up. Obviously, if market price goes further down, then we can write down as long as we are in the proper range, but writing up is not allowed. The question then becomes, if the inventory value is going up, how do we benefit from that? And the answer is, you benefit when you actually sell. When you sell, then obviously if the inventory item is up, then you can sell at a high price. The cost that you will show is 47, and obviously the profit will be good. Section 5, presentation and disclosure. There are certain disclosure requirements for inventory. This is essentially telling us what must be shown on the financial reports and what must be disclosed in the footnotes. I don't think this is overly important from an exam perspective, but in any case, read these items a couple of times. That will give you a good sense. Plus, if you've not done so already, take a look at a few financial reports and this material will then become obvious. Changes in inventory valuation method. There needs to be consistency of inventory costing in both IFRS and US GAAP. We have touched on this before. What this means is the following. Let's say you have a US GAAP company that is following last in, first out, and they make a change. They go from last in, first out to first in, first out. For this change in accounting policy, there must be a very good reason that is justifiable. And secondly, the historical reports need to be restated. That is because we want the reports to be comparable. If we do not restate historical reports, then the inventory reported with FIFO cannot easily be compared with inventory from earlier years that is reported according to LIFO. Evaluation of inventory management. The question here is, how well is management taking care of inventory? Generally speaking, what you want a company to be doing is maintaining a low inventory balance and at the same time high sales. So high sales means that cost of goods sold is going to be high. If you recall from our previous reading, that essentially is our inventory turnover ratio. A high inventory turnover ratio implies good inventory management. And as we've discussed before, days of inventory on hand is simply 365 divided by the inventory turnover ratio. This is an indication of how long on average inventory is kept or how many days of inventory is kept on hand, and here we want a low number. Obviously, if the inventory turnover ratio is high, then the days of inventory on hand is going to be low. All else equal, a high gross profit margin is good, which means that if you have your sales and you have your cost of goods sold, for a given amount of sales, you want relatively low cost of goods sold, which means that you want a relatively high gross profit. Gross profit over sales is your gross profit margin. When you are comparing two companies in the same industry, the company with the higher gross profit margin is doing a better job of keeping its inventory costs down. You need to recognize that the choice of inventory valuation method impacts several ratios. Clearly, cost of goods sold and inventory balances are impacted depending on whether you are using FIFO or LIFO. So if you are comparing an IFRS company with a US GAAP company, chances are that a US GAAP company will be using LIFO, an IFRS company will most probably be using FIFO. You can't just look at inventory numbers and compare them. You need to make adjustments. And exactly how those adjustments are made will be discussed in detail at level 2. I would encourage you to go through example 5 in the curriculum. This is a long example, but it highlights the points we've talked about very well. What is the impact of inventory valuation method on the following ratios? Let's consider 3 inventory valuation methods. FIFO, LIFO, and weighted average cost. And let's consider the impact of these three methods on all these ratios. Let us assume a rising prices environment. You buy your inventory for $1 first, and then inventory is purchased for $2. The inventory turnover ratio is COGS over inventory. With FIFO, we have first in, first out. So the $1 inventory is sold first. COGS is low. Inventory is what is left. That is relatively high. So COGS over inventory, the inventory turnover ratio is a small numerator divided by a big denominator, which gives us a low number. This is low relative to what we would have under the LIFO method, and the weighted average would be in the middle. So we would say, if we were comparing weighted average cost with LIFO, we would say that inventory turnover using weighted average cost would be higher than if we were to use FIFO. Days of inventory, we don't need to do much work here. With LIFO, if inventory turnover is low, then automatically we know that days of inventory is high relative to the other methods. Gross profit margin is gross profit over sales. Since we know that COGS is low for FIFO, that means the gross profit is high. Sales numbers are not impacted by the accounting method. So if the numerator is high, then FIFO will give us the highest gross profit. Current ratio is current assets over current liabilities. Current assets are high with FIFO because you have sold the 1-1 and you are left with the 2-2. Current assets high, current liabilities are not impacted by the accounting method. So our ratio current assets over current liabilities will be highest with the FIFO method. Return on assets, net income over assets. This is slightly tricky. Net income is higher with FIFO because our cost of goods sold is low. Assets are also higher, but note that the impact on net income is going to be much more substantial than the impact on assets. And you can look at the numbers in the example, or you can simply take my word for it, that net income in percentage terms is going to be much more relative to the increase in assets. And therefore, overall, this ratio for FIFO is going to be higher relative to the other methods. Debt to equity. Debt is not impacted by the accounting method. Equity is higher with FIFO because we have higher inventory values, and therefore this overall ratio is lower for FIFO. That brings us to the end of this reading. I will summarize the most important points. You need to know how to come up with the cost of inventory, and this had to do with the amount that needs to be capitalized. Remember that your raw material that goes into the inventory, the conversion cost, the transportation to the warehouse, or the transportation of the raw material, all that is capitalized. Any abnormal wastage is expensed. Overhead expenses that cannot be directly linked to the inventory has to be expensed. Showroom storage costs are expensed, and so on. We then talk about the different methods such as FIFO, LIFO, weighted average cost, first in, first out, last in, first out, and weighted average cost. We simply look at the total cost of our inventory divided by the total number of units for sale. Impact of valuation method on inventory balances and COGS. You need to understand how these methods impact what we show as inventory and impact what we show as cost of goods sold. And then this in turn will impact the various ratios which we just talked about. I think from an exam perspective, these elements are perhaps the most important, and specifically I would say that you need to understand the impact on ratios. The way you will probably be asked about this is comparing two companies which are using different methods, and you need to see how the use of different methods impacts the ratios. And then measurement of inventory value is important. At the very least, you need to recognize that under IFRS, we need to record inventory at lower of cost or net realizable value. If we write down, then with IFRS, we can write back up as long as we get to the cost. We cannot write up above cost. So those are the most important points that you need to be on top of. As I keep saying, go over the summary, review the learning objectives. The examples in this reading I think are very good. Some of them are a little long-winded, but I have actually referred to them in this lecture. So if you have time, try to do these examples. The practice problems, as always, are extremely good, and you need to spend time on them. They are not enough, so try to do practice problems from other sources as well. That is it.